Hello and welcome to SwitzerTV Property. I'm Peter Switzer. And at a time when the Treasurer tells us we're in a recession, renowned property bull Chris Joye of QLD Capital Investment says he's hunting property bears who he says are so wrong on property prices. And then we shine the property price spotlight on Brisbane and its surrounds with Destiny's Margaret Lomas and Century 21's founder Charles Tarby, who pinpoint hot suburbs and towns for property investors. And finally we catch up with Paul Miliotis, whose business is at the coalface of the property sector. That business is called M Squared Capital. So let's go and catch up with the bear hunter himself, Chris Joye. Well, my first guest on the program is no stranger to the property show. His name is Chris Joye, founder of QLD Capital Investments. And I've been, arguing with Chris for nearly a decade, and primarily I'm always right and he occasionally gets it right, but geez, going through a fantastic run, absolutely on the money when it comes to the coronavirus and where markets will be heading. And so his latest offering that we've been reading about is that he's hunting down bears, and particularly property bears, and he wants to barbecue them. Chris Joye, thanks for coming on the show.
Thank you, mate, for having me on the show.
Why do you say you're hunting down property bears?
Yeah, so Peter, it is indeed true that the Wolverine is hunting some housing bears, and we've seen them start to backtrack. So it's quite conspicuous that the first few bears have started running for the hills when they sighted my double-barreled intellectual shotty. So UBS has said that originally they called for a 10% drop in house prices, but now they're saying that may no longer be the case. We've had AMP's Shane Oliver tell us that his worst case scenario of a 20 to 30% drop in house prices won't come to fruition. And we've also seen today Morgan Stanley start to backtrack from their negativity.
You did tip a long time ago. In fact, it was in March, because I know I presented at a conference in late March. It was probably the last real life conference held in this country. And I actually put a quote up at the end of the PowerPoint that you said that eventually, words to this effect, that once markets see what's needed to be seen in terms of infections and deaths, it would be a buying opportunity of a lifetime. And we've certainly seen that on the stock market. Haven't seen it with property yet, Chris. What do you think is going to happen to property prices down the track?
Well, as you said, we built very sophisticated forecasting models for COVID-19, and we projected that new infections would peak in early April in Australia, US, and much of Europe. And we thought that when the market saw that peak passing, that would be a great buying opportunity. And we thought that economies would come out of containment much more quickly than the government or policymakers expected. And that's obviously what's transpired. So we put our money where our mouth was at that time. So I spent $942 million buying assets, mainly in March. And we've started taking profits in April and May. In respect of housing, our view has been very consistent since February. Basically, we have hypothesized that there might be a sort of circa 6-month soft period in prices where they would fall by up to 5% or move sideways. And we saw that house prices nationally rose over January, February, March, and April. They've fallen very modestly in May, according to the best available index that we have, which is the CoreLogic Hedonic Daily Index. And that put prices down in seasonally adjusted terms by about 0.2 of a percentage point in the month of May. May is actually the second weakest month of the year after January in seasonal terms. And in May, we normally see house prices actually fall by about 0.2%. What is interesting is obviously the Prime Minister has jumped his 6-month business hibernation plan because the infection curves have flattened much more quickly than the epidemiologists thought. All the epidemiological modelling was totally wrong. Obviously, they thought there'd be thousands of Australians on ventilators, tens of thousands of deaths, and a peak in new infections in circa July, and we obviously passed through that peak here in Australia right at the start of April. And with the recovery in activity, we're seeing a corresponding bounce in housing activity. So we're seeing auction clearance rates that are quite high, in the sort of 60 to 70% range in Sydney and Melbourne, and higher than they were 12 months ago. And what's also interesting, and this is admittedly very tentative data, but we are seeing just over the last 2 days, house prices start to increase. So I would expect, given the quite outstanding Australian experience in crushing COVID-19, I'd expect us to see prices to start to flatline pretty soon. Obviously, the market's going to be supported by additional housing stimulus that the government's going to provide. But the main sort of basis of our forecast is the 75 to 150 basis points of mortgage rate cuts that borrowers have benefited from since April last year.
To me, that if the optimism that is on the stock market, and which will probably go into the property market, so I should have said the stock market, optimism there, which will go into the property market, all that could be brought undone if there were serious second wave infection threats. Now, knowing you would have been doing some research in the likelihood of that happening. What is your take on that?
Well, in the same way that we're saying there's not a snowball's chance in hell we'll get a 20, 30% drop in house prices, and prices will be flat to down 5%, followed by the boom reasserting itself. And I probably didn't make that clear earlier. A key part of our projection is we were the first analysts in the market in April last year when prices were falling to say, listen, the bust is over, prices, and we called that bust as ahead of other analysts in early 2017. So we called that 10% national correction in prices when every analyst in the market was forecasting price rises. And then last year, we called a 5 to 10% sharp increase in house prices following the second RBA rate cut, and that's what happened. And I think that boom will reassert itself. So I expect to see house prices rise by another 10 to 20% over the next few years. And there's probably some upside there. In terms of second waves, we have data science systems that literally track every infection and fatality reported in every region, state, territory, and country in the world. And what we're seeing is that in Western Europe, curves have flattened. In much of Southeast Asia, in fact, throughout Asia at large, curves have generally flattened. But there are obviously new national outbreaks emerging. So we are seeing significant increases in infections in Russia, in Eastern Europe, in South America, in India, and other developing countries. So I think you'll get a second global wave. We've always anticipated this, but that's just a function of the virus propagating around the world and more and more countries having to contend with it. And obviously different countries have different efficacies, but we do not expect that there's really any likelihood of a second wave in Australia. I think you'll see sporadic outbreaks. There's definitely that possibility, but our view is that human behaviours have changed so profoundly, and the mitigants now are so strong, and crucially the testing is so good, that the likelihood of a sort of mass market second wave is very, very low indeed. To your point about buying opportunities, mate, as you know, I mean, we bought $942 million worth of bonds. I spent $300 million actually buying hybrids in March as well, as part of that program. But our view was that equity beta, by which I mean the equity market, would always react very positively to our forecast of really massive unrestricted liquidity support and quantitative easing, which is asset purchases by central banks and treasuries. So in February, we projected that the pandemic would lead to a solvency and liquidity crisis unless we got a liquidity and QE bridge, so an asset purchasing bridge through to vaccines. The central banks were a little slower than we expected. I expected them to come in week 1 or 2 of March. They came in sort of weeks 3, 4, 5, but they got there, and it's had a massive impact. And what we're seeing in markets right now is basically central bank liquidity and asset purchasing programs overwhelming all the anxiety and concerns around fundamental valuations. And there's a lot of uncertainty around those fundamental valuations in places like the stock market. But I do think that as we normalise more rapidly than people expect, given our effectiveness in containing COVID-19, that activity will bounce back more rapidly. So that's why we've coined this term of a VU or a VU-shaped recovery, Peter, where we get a much quicker than expected bounce in activity. And that was actually the second part of our kind of hypothesis. So we basically in March said that as we pass through the peak in infections, that'll be a trigger for positive market price action. And then secondly, we said as economies come out of lockdown, that'll be another trigger. And that's more or less what's transpired. However, once we do come back online, I think the world will be fundamentally and permanently different. And there are a few risks. So the first risk is just the economy is going to be reshaped. There are some over-leveraged, unprofitable business, the zombies, businesses, the zombie companies, as we call them, that will go out of business permanently. So, the Virgin Airlines and retailers around the world that we've seen are kind of fall into that camp. And then we've, of course, got the risk of a new Cold War between China and the US.
Leave the trade war stuff until it actually becomes very real, if it's going to become real. I want to get you to talk about at the worst scenario for Australia, and it's probably when they were talking 6 months of hibernation, they were talking about economic growth being down 10% this year and unemployment going to 10%. What's your take on those forecasts?
Yeah, I think that the Treasury's projections were inherently very conservative, and that's been manifest in the JobKeeper numbers. I mean, they overestimated the cost of JobKeeper by $60 billion. Now, that's not a negative thing. It wasn't a mistake. It was a forecast. And the Treasury's forecast was based on these epidemiologists' forecasts for COVID-19, which obviously projected many more infections, many more deaths, orders of magnitude more deaths, and a peak that was in circa July rather than or at the beginning of April. And so I think that the economic outcomes are likely to be much better than the government originally intended. I think you'll find that the economic results will be such that we have a short, sharp contraction followed by a very quick recovery. But the real, I guess, focus is what's going to happen over the next 6, 12, 18, 24 months. And I think that the outlook over the medium term is actually quite mixed, because on the one hand, the world's going to have much more debt, more private debt, more public debt, and that will put downward pressure potentially on growth. And then on the other hand, I think we're going to have the emergence of this new Cold War between China and the US, which could create an enormous amount of volatility. I think you hinted earlier that the fact that markets don't really price geopolitical risk until it becomes absolutely ubiquitous or in our faces, so to speak. But this is something I'm spending a huge amount of time diligencing and analysing, and that is China's relations with the rest of the world.
Will we see negative interest rates here, Chris?
I don't think so. The RBA has all but ruled them out. I think the exact quote from the Governor, Phil Lowe, is it's extraordinarily unlikely.
Yeah, and do you think it would ever be necessary, given what your crystal ball is telling you about the Australian economy? Do you think negative interest rates are required or necessary?
No, I think actually perversely or paradoxically, or perhaps by design, Australia's going to be a massive potential winner. And I'd emphasise the word potential for one particular reason. Australia has contained COVID-19 as well as more or less any country in the world, with the exception of, say, perhaps Hong Kong and New Zealand. But we've really had a brilliant experience with containing the pandemic. And I think that as businesses around the world look for headquarters in Asia, with the Chinese Communist Party basically looking to take control over Hong Kong with the passage of their new national security laws, I think that there are many global businesses that will be looking to Sydney and Melbourne as key Asian hubs for their global enterprises. And I think you'll see a lot of businesses shift out of China and Hong Kong and relocate back to, or to, for the first time, Australia. I think you'll also see a significant increase in immigration over the next few years. And much like we saw with South Africa and the immigration into Australia from South Africa, I think you'll see a substantial amount of highly skilled and very financially well-endowed capital flowing to Australia from mainland China and Hong Kong, particularly from Hong Kong, because I think the threats to the rule of law, property rights, and humanitarian rights are such that I think many folks have some pause about those risks. And so I think Australia has a big opportunity. At the same time, we came into this crisis with a balanced budget, one of the few countries in the world that was balancing their books. We aren't going to take on nearly as much public debt as we originally anticipated. And commodity prices remain very, very high. And obviously mortgage rates are around 2%, the lowest they've ever been in recorded history. And the Aussie housing market's very interest rate elastic because most borrowers are on either variable rates or short-term fixed rates. And so I think that Australia will do really, really well on a relative basis. One question is, can we capitalise on this opportunity to make Australia the sort of financial centre of Asia? And one key reform opportunity would obviously be tax rates to make them competitive with Singapore.
Okay, mate. Well, as always, great to talk to you, and I hope your forecasts continue to be on the money.
Thank you, Peter. I really appreciate the opportunity.
Well, I've been talking to my friends and colleagues and experts about Brisbane property prices for probably 4 or 5 years now. I'm talking about Margaret Lomas from Destiny, and of course Charles Tarby, the founder of Century 21. And at this time, with the coronavirus obviously putting some challenges for the entire property sector, and given the fact that to date, Sydney and Melbourne house prices, I know, haven't moved down as much as some people are predicting, I'd like to see what their current views are on Queensland and particularly Brisbane, where they've both had fairly positive views on some property areas in and around Brisbane. So let's catch up with them and find out their current views. Margaret, let's kick off with you. What's your view on, say, Brisbane apartment prices?
So I'm still a little bit bearish on Brisbane apartment prices. As you know, the market was flooded quite a few years ago as a result of a couple of things, projects that had gone on hold because of the floods. And then obviously Brisbane itself sat flat for a little while. And then we also saw an oversupply into South Bank and its surrounds. And we saw many of those apartments selling and then reselling at well below what their original price was. Now, the oversupply is shifting a little, but it's still there. And on top of that, there's a lot of problems with some of the buildings in South Bank. The building hasn't been as good as it could be. There are defects which are devaluing those apartments. And I'm still thinking that you should stay away from the Brisbane apartment market for now in the inner city.
Yeah, I agree with Margaret in that sense. There wasn't certainly an oversupply. West End got a massive oversupply of apartments, and we were saying to people, hey, you're probably going to be getting less for these at the end of the construction than you think, than what you paid for. Brisbane's been flat for a while, and I think that a lot of apartments in the Brisbane area, South Bank area, are like golf courses, Peter. They say to the person who buys, who's the third buyer or second buyer of a golf course is where the money is made, not the first. And off the plan, sales have had a terrible time. There are lots of apartments, complexes in Sydney area that have also been badly built. And of course, when people buy these, they've got an expectation. Everything looks fantastic. But as things move on, things change, costs go up, builders' issues occur, and quite often they pull back on some of the quality that's there. There are some great builders out there that have maintained their quality, but there's certainly been a fair share of those that have caused people problems. But Brisbane market itself, I think, is ready now because it's always been flat for a while. Sydney was expected to drop during the coronavirus, which we felt was not going to happen, and we still feel that way. Not the 33% that CommBank predicted. And I think because of that, people with equity in Sydney will start to look in Brisbane again for those who want to invest, because it'll be a good spot to look.
And I don't disagree with that, Peter. It's just the apartment market that I think is still a little stay away from the apartments.
While we're on apartments, are there segments, like I can recall people saying to me, if you are thinking about buying an apartment in the Brisbane CBD area around the river and whatever, do not even think about one bedrooms because there's just so many of them and often the qualities aren't great. But if you're looking at higher end properties and apartments, that might be a different proposition. Would you largely agree or disagree with that, Margaret?
Look, I think we have to understand who we're talking about as buyers as well. So if you're talking about someone who is looking to maybe retire into an apartment as a downsizer, or someone who's just starting out their owner-occupied journey as an owner-occupier, then definitely I would agree that one bedroom in Brisbane is still suffering from a lack of demand. It's certainly an accepted kind of an apartment in Melbourne and Sydney, but Brisbane people, because the prices are significantly lower, because wages are similar to most of the country, they can afford to pay more, and therefore they're still seeking those 2 to 3 bedroom apartments. If we're talking about an investor, then it is a different argument altogether. An investor has to think about what they're going to get as a return, so what their rental yield is going to be, and what the chances are of capital growth. So for an investor, notwithstanding the fact that I'm saying don't buy in the apartment market at all in Brisbane as an investor, if you did, you'd be looking for those apartments that were going to get you the most demand, and that's definitely those 2 to 3 bedders.
I came across, Charles, a guy by the name of Tim Forrester from the ARIA Group.
Sorry, the name of?
Tim Forrester from ARIA Group, and he's won a number of Australian awards for best developments of the year, and he just makes high-end apartment complexes, and they tend to sell out, and they do attract the people that Margaret was talking about. A lot of potential downsizers who actually buy the apartment for 4 or 5 years, rent them out, and actually move into them after they take possession after buying off the plan. And they've often bought them, pretty well sometimes positive cash flow because they are high-end apartments that attract very high rents. What would you say to someone who is actually thinking about having a strategy like that, where you bought a high-end apartment where there is actually proven big demand to be in the actual apartment complex?
Yeah, look, some of the high-end apartments in the capital cities, particularly Sydney and Melbourne, have held out really well. So I don't see a problem with Brisbane. I think Brisbane is starting to mature that way. It's still a bit risky, but I think it's got a lot more maturity than it certainly had. And you only have to look around and see the restaurant scene in Brisbane, and that gives you an indication. But there are some failing areas there also close to the city that aren't doing as well as people expected. When you go back to what Margaret was talking about with one-bedders, even one-bedders in some parts of Western Sydney are dangerous to buy. In the city of Sydney, you can buy one room fully self-contained with everything in it, and it's not dangerous. But, investors going up to Brisbane to buy, particularly, you wouldn't want to go all the way up to Brisbane to buy a one-bedroom apartment. So I'd certainly be looking for 2 and 3 and something a bit more luxurious. But the city scene in Brisbane is still a fair way to go before it matures. But I think that the upmarket properties are going to hold out better than the lower-end ones.
Margaret, what do you think of the high-end apartments in Brisbane? As Charles points out, I think in Sydney and Melbourne, particularly in those, trophy blocks, they've done well. But what about Brisbane with that kind of play?
So let's again separate out investors from owner-occupiers. And for someone who is planning to downsize and retire there eventually, to them it's good to get a good yield in the short term. They'll move into it, but their reliance on capital gain is really reduced because it doesn't need to grow well for them. They're going to live there and probably see out their retirement years there. And therefore they're not looking for that capital growth argument in so much as they're looking for that short-term rental yield and then the capacity to live in something luxurious for themselves. Although I tend to disagree that a high-end apartment gets relatively high rents. They get higher rents than a low-end apartment, but relatively they get a lower rental yield than a low-end apartment. And that's been proven time and time again because of the high price that you pay to get in. So the reliance on capital gain is reduced. If you're an investor, I don't recommend buying a high-end apartment because they tend to follow a different pathway and cycle than the general market does. You know, if we've got any problem in the economy, then those high-end properties suffer immediately. Even if the underlying market is still doing okay, high-end properties can be impacted by that. They can be a little harder to sell because there's less people buying them. So as an investor, you don't have the demand there for them that you do if you're buying something that's a little bit more standard and vanilla, that you can just put tenants easily in, such as a 2-bedroom apartment. You know, the other problem when you're spending so much in one area is that as an investor, then if that gain doesn't materialise, then your entire investment strategy can really be impacted. But I do agree that a luxurious apartment in the kind of building that is unique rather than one with, 60 that all look the same. So those kinds of smaller apartment blocks, many of them are older apartment blocks with particular features that you don't get in new apartments, like higher ceilings and bigger rooms. I do agree that they can be in demand. However, they still don't get the relative rental yield that those cheaper apartments can get.
Let's go around and I use the old family test. Charles, a family member of yours, comes to you and says, I've got some money and I want to buy an investment property in Brisbane, either apartment or a townhouse or a home that will give me a reasonable return. Where would you recommend? What would you recommend and where would you recommend?
I wouldn't recommend an apartment, and again, any level from one bedders up to the top end. I think if you want lifestyle, you can go to your top end. But my view is a house still in Brisbane. You can still do very well in the top part of Brisbane, the northern part of Brisbane, the rail lines going through all the way. The north part of Brisbane all the way up through to the Sunshine Coast has continued to grow. A lot of great suburbs, not far from the beaches. You can still get a great 3-bedroom investment property on a piece of land, albeit that the developers are now starting to cut down those sizes of land in some of those areas. But for me, it's the North Lakes all the way up through Redcliffe, Scarborough, up those areas. I still think, from what the feedback I get from our officers there, is that they just can't get enough stock still to sell. So there's a very, very high demand in that area.
Same question, but I always used to laugh that you used to like a place called Deception Bay, which I thought would be really hard to be a real estate agent in Deception Bay.
Well, it's interesting that Charles is actually talking about that very area now, Deception Bay, Rothwell, which is where the train line's gone. The train line's going up into Petrie for that new university development. And then in years to come, it will continue up through Caboolture and into the Sunshine Coast. And I do want to say that my family asks me every day where they should invest, and so do random strangers on the street. So I am asked this question an awful lot. In recent times, and I'm talking in the last couple of days, I've actually been doing a little bit of an analysis of that Brisbane market because I really want to get a feel for where the demand is really lying. And I've had 5 areas emerge as having, first of all, rental yields above 5%, so 5% and above, population growth faster than the national average, and also areas where we're seeing a ripple effect because we've had suburbs that have become very popular and grown in value but are now priced out of many people's pockets. And so the ripple effect occurs and suburbs surrounding them are the ones that are gaining the attention and the demand. And basically we've got Coomera on the Gold Coast, which comes into and out of demand, but that's back on as being a really hot area to invest. $500,000 median, but you can buy there from $420,000. If we go up into Springfield Lakes, which is south of Brisbane, we've got both Springfield Lakes and then Bellbird Park for that ripple effect. Big population growth going there, matching that demand at the moment with suitable construction, but that's starting to wane down now, and we're going to start to see more demand than supply. And you can buy in there from $325,000, and that's for a house. So I'm talking houses in all of these areas. If we then go up into the Sunshine Coast, just around Caloundra there, we've got a little place called Baringa, and Baringa is actually showing huge demand, big population growth, and prices from just around $460,000 with over 5% return. And of course, in years to come, that will continue to grow as that rail line goes in. And one more place is down around Desert, which nobody knew existed before. I did a town spotlight down there about 15 years ago, and there was one 8-room motel that we stayed in there. But it's the salad bowl of the southern parts of Brisbane, and it's really starting to hit its straps now. And Cedar Vale is very much in demand, big population growth there, houses from 475,000 with a median of just 550. And it's a really, really good prognosis for the future.
These numbers, Margaret, are very interesting because the build-up, you've got that data backing up what you're saying, and at the front end, I've got the agents telling me what they're needing, more listings and so on in certain areas. And one of the areas you picked in reference is Caloundra or the Sunshine Coast. That's been the most dynamic part of my 3 years. We have had more outstanding performing agents and officers in that area than in the rest of the country. And in Caloundra, I've got 2 agencies in that area, and both of them are just moving so quickly. They've even opened up in Biwa, up at the top of Peachester, in the hinterland area. And I didn't know much about those areas, but there's thousands and thousands of people living in those areas, and some of those areas that just even getting away from the centres like Caloundra are also booming as well. Haven't stopped. Their market just haven't stopped even during COVID. They've so many inquiries and have been so busy.
And the reason for this is that it offers both lifestyle for just the everyday working person with an easy commute back into the Sunshine Coast. It offers the ability for downsizers who are retiring to move in. And with those above 5% rental returns, it's great for investors. So you've got all sections of the market looking there.
Yeah.
I think it's been very insightful. And of course, what I find fascinating about Queensland is that despite the fact they won't let anyone get into the place at the moment, they really do know how to name a suburb. All those suburb names were wonderful, like Bow Desert and what was it, Belfield or something like. Great names. You see good reason why you want to live there. Once again, Margaret Lomas from Destiny and my old mate Charles Tarby, founder of Century 21. Thanks for joining us, guys. Well, each week we like to try and get someone in the sector, the property sector, to see what's going on, what's the kind of feedback they can give us to work out whether, for example, will the doomsday merchants be right, and some of the big bad scary calls like those of Harry Dent and others. And even the Commonwealth Bank had a pretty scary one out there of 33% fall in house prices. If the worst case scenario comes along, and it was only their worst case scenario, it wasn't their base case. So the guys I always like to have a talk to, once a month or so, the guys from M Square Capital, and I've got Paul Miliotis here to talk to me now. Did I get your name right this time?
You did.
You smile.
You always say the same thing about my name.
Well, you Greeks, you pick on people like us when we don't pronounce your name right. They're like that. All right, mate, great to see you. All right, so just to position you so people know what you do, give us an example of what your business does.
Look, I think I'll give you the most recent example of what we did. So we're a non-bank lender, but anytime we say we're a non-bank lender, it does confuse people.
Yeah. You don't look like CBA, don't you?
No, well, there you go. But we had a borrower come to us that had a need for money. Okay. He had an unencumbered property. So
business borrower? Or
business borrower.
Okay.
So he needed the money for business.
Okay.
He had a property in Lilyfield, New South Wales, just a nice 2-bedder unit with a view of the Harbour Bridge. And he needed a need for some money to shore up his business. Okay. So he came to us for the money. Okay. We went to our investor database and our investors would effectively say, yes, I'm interested in lending this particular person money. And we lent, our investors got a great return of 6.5% per annum on that particular investment. So being a secured lender, we took a first mortgage over that particular property. Yeah. So the security for our investors are the first mortgage over a bricks and mortar security of the Lilyfield property. Yeah. Importantly, he wanted 60% of the value of that property. And the investors I mentioned before got 6.5% per annum return. So for every $100,000, it equates to basically a monthly income for those investors of, give or take, say $540.
Okay, so for people who are not comfortable with sort of stuff, let's just get the details. Basically, if the place was worth $1 million, he would have borrowed 600,000.
Exactly.
So if he didn't pay his bills, you guys would sell the place, and therefore it's highly likely you can always get that money back, and therefore the risks for the investors become minimised, but they're still there because you're not term deposits. If you're term deposits, they're the safest in the world. Anything above is a little bit more risky. But what you're trying to say is you try to reduce the risk.
That's right. I mean, look, I think importantly we're in a first mortgage position. So you
but
have...
people understand that. You understand. What's the importance of the words first mortgage?
Well, I think it's a very important... Anytime that anyone wants to invest in the sector, they need to understand what they're getting themselves into.
Yeah.
A first mortgage is effectively, we are like a bank in that you are taking a mortgage over that property in first ranking security. So you are the first to be able to call on that mortgage if, in the unlikely event the client defaulted, you had first ranking security. So for lack of a better word, the power that you have is stronger in a first mortgage position.
Okay, good. Okay. And so let's all link this in then, because, you know, the worst case scenario would be if we fell into a disgraceful, disgusting, scary depression. And Harry Dent has been running around the world telling this is going to be a really bad thing. And so far he's been proved wrong. But you must have a pretty good idea what's happening to house prices, because you would have had to value that property.
We did. And look, to be honest, when COVID first hit, the first thing we did was look at our book and look at our properties that we have security over, and had a view within M squared that said, well, how far do we think those properties could fall as a worst case and as a best case? Now you hear the banks, for argument's sake, say, you know what, worst case you could have a 30% drop in property values. We came on the show last time and said, look, we found that quite bullish. We never thought that could actually happen, even with...
Well, maybe we should say bearish.
Bearish.
It's so big, you mean, don't you?
Yeah,
big on the downside, yeah.
Correct. Yeah. But in saying that, even if the worst happened and property prices did drop 30%, if you look at the example I just gave on the Lilyfield investment, when you're lending 60% of the value, we would suggest that you are quite covered with some buffer for our investors to get their money back. I mean, we had our own prediction that we thought that now we're talking residential mortgages now. I think it is very different from a commercial property perspective. We said residentially that we thought you could have seen a reduction in property values between 5 and 10%. We saw the data come out recently, and last month in the capital cities it dropped by 0.5%. That's 0.5%. If we looked at the 2017 numbers, when residential property dropped at 18%, you were looking at numbers of 1.5% a month, 2% a month. Now we were in complete lockdown with businesses not operating, and now we're seeing a 0.5% reduction in the capital cities. So a far cry, I would suggest, from what the doomsdayers were saying. Okay.
Harry's got a lot of publicity. We had him on this program, and lots of people tuned into the property show to see what he had to say. But it was actually the investing show. But what are the other experts in the space saying about house prices?
Look, I think we're all screaming in agreement. That's the funny thing, I believe. If you make assumptions that unemployment will stay at 10% or higher, people are saying, and across the board, that there'll be a reduction in values of up to 20%. If those assumptions are taken off and we think we're going to see quite a bump in the employment numbers, people are saying 5 to 10% now. So I think we've all kind of lined up together saying, we are not out of the woods yet. We have to see what happens. But is the likelihood that the property prices are going to drop more than 10%? I would like to say consensus is saying no.
Yeah, and people like Louie Christopher from SQM is basically, he said a 40% is possible for worst case scenario came along, but he's more in that sort of 5 or 10%.
Look, we've seen people come back now and say, look, the likelihood of the worst case is unlikely. So the likelihood of us dropping that 20, 30% is highly unlikely now.
And for anyone in business, that's a really good thing to hear.
It's great.
Okay. Now your colleague Paul Mirren, who thinks himself a lot smarter than you know that, wrote a great piece, and he talked about Australia not necessarily being a lucky country, but being, in a sense, the luckiest country. What are the standout things that he observed that you hung on to and said, yeah, this is going to be good for us going forward and the property market? Look,
the reality is when we thought we were going to have 100,000 deaths in the country, and we have just over 100, which is horrible, I think that in its isolation, by definition, makes us very, very lucky. But our way of life hasn't changed as much as the Europeans have. I was able to go for my walks in the morning with my 1-year-old. And without that, as my friend was in Spain, he couldn't leave the house. That would have really affected me and my family. So I think we're lucky that while we were restricted, everyone did it in a smart manner, and we're able to have a little bit of freedom in that way.
Have you picked up a level of anxiety from some potential investors or potential borrowers? What is the anxiety reading that you're picking up?
I think the best example is that we're actually seeing green shoots now, which is kind of on the opposite side of the anxiety level. Initially, we did have anxiety, as we said. That's abated. So if I go back to the Lilyfield example, we launched that investment opportunity to our database. It was oversubscribed 3 times over in 2 hours. We couldn't believe it. So I think there is a move from investors now to look at more defensive style positions. I mean, if you're investing in a mortgage fund, you can walk past the property that you're secured against. It's bricks and mortar security. The investors are also telling us they are loving a monthly return month on month on month. So we are definitely seeing green shoots investor side. We are seeing people that wanting maybe to control their capital a little bit more and have a bit more say in where they're investing in. They're also telling us they like the opportunity to pick and choose where their money's going, which suits the M Squared capital brand, because we have a contributory fund. I know you hate that, but you can pick.
No one knows what you're talking about.
I was waiting.
You can say if you want
it. But it means that you can pick and choose which investment. You're not pulled into one fund. So
not pooled.
You're not. If you don't like construction risk, you don't take it. So our investors are saying, what, if I can, pick and choose where I want to lend my money, you can pay me my monthly instalment every month. And my capital is preserved. We're seeing positive.
And one thing I should say, you talked about the investors. Are they sophisticated investors? Do you have to be a sophisticated investor to invest with you?
You do. I mean, look, the definition of sophisticated investor, we don't like saying sophisticated, but you need to be fitting certain criteria to be investing with us. We've got a $100,000 minimum, for argument's sake. You need to meet certain thresholds.
Certain assets,
certain incomes.
You've got to show that you actually do understand what you're investing in.
That's right. And I think, look, regardless if you're sophisticated or not, you should be understanding what you're putting your hard-earned money into. But our mortgage fund is for sophisticated investors.
Okay. And you being an accountant, you would actually work out what a sophisticated investor is.
No, it's pretty. To be honest, it's actually pretty easy. It's defined.
Would you like it to be harder?
No. I didn't say that. But it is a defined process. So there's nothing sexy about what we do. And I know you say accountants are sexy, but
there you go. When people think sex, they think accountants straight away.
100%.
Paul, thanks for coming on the program.
Thank you, Peter.
That's Paul Miliotis from M Squared Capital.